what a broken wing butterfly does is take people's positive and the people's negative mentalities and merges them together and comes up with a way to make the butterfly a great product for the people who love them and hate them. Okay, so what we're really doing is just pulling the tail a little bit further apart. Or another way of looking at it is simply buying one vertical spread and selling another vertical spread that is a little bit wider. Now, why pull the tail further away? And I already mentioned it. It's just to reduce the cost of the butterfly. Now, a lot of people say, well, won't I have incurred more risk? And the answer is yes and no. Mostly no done right, which is the key in how we were earning our living on the trading floor and how Random Walk earns its living by teaching you how to do it the right way. Yes, you will be increasing risk on a theoretical basis. You will be increasing risk on a profit and loss at expiration graph, but if you do it right, you will not be increasing risk that much. As a matter of fact, an argument can be made that you will actually be lowering your risk, and I'll give you an example of that argument right now. When on the trading floor, most floor traders, especially in the indexes, were making a great living doing ratio spreads. And I'm talking about selling the ratio spread, not buying it. The public is taught by various gurus in the markets to buy ratio spreads, where you're buying two options that are out of the money and selling one option that's closer to the money, so that what you're really doing is selling a vertical spread and using the proceeds from that sale to buy an extra option. And they're taught that by looking at risk graphs, how great this thing is if the stock goes from 60 to 200. But that's not very realistic. Now, every time somebody goes in as a market maker on the trading floor, every time a public order comes in, we have to take the other side of it. So as everyone's buying these ratio spreads, we were selling them, and we loved to sell them. And we didn't feel we were incurring much risk. And the reason for it is real simple. I'm going to show you. For example, instead of buying the butterfly, let's say we just bought the 380 put one time and sold two contracts in the 360 puts. The public is taught to do it the other way, where you buy the 360 put twice and sell the 380 put once, and what you have on is a back spread. On the trading floor, we were doing it the other way. We preferred to own the option that was closer to at the money and sell twice as many options further out of the money to pay for it. And we didn't feel we were incurring much risk. And the reason for that is simple. Okay, and it's because we understood deltas. I'm sure everybody listening to me understands what delta is, but I'll give you a quick definition. Delta is just a measurement of how much the option is going to move as the underlying moves $1. So an at-the-money option, by definition, has a 50 delta. If the market moves 1 point down and you own a put where you want to make money because the market's moving down and your delta is 50, your option will move 50 cents for every dollar the market moves down. So if the market moves down $1, you make 50 cents on your option. Now here's a look at the deltas, the actual deltas that I took off of closing prices of the ratio spread we were looking at. If we buy one contract of the 380 put and it has a negative 48 delta, remember, options have a negative delta when we're dealing with puts. If you buy a put, it has a negative delta. Okay? So, excuse me, buying one put that has a negative 48 delta, and then we sell two options that have a negative 24 delta, well, the sale of an option with a negative 24 delta, a negative times a negative is a positive, 24 times 2 is 48. So the 360 puts have a positive 48 delta. So this position actually nets out to be delta neutral. So what we have here is a position that's actually delta neutral. If the market moves down, we do not have to worry about it. And I've learned over the years that people have a better understanding of these things from a graphical point of view. And so I'm going to show you an image where, let's say, the at-the-money strike, whatever it is, we'll call it 400, is right at the mean, the top of the normal distribution curve that we're looking at right now. We can go and look at this line right here, the first line to the left, and we see it has a minus 46 delta. Okay, we buy one of those, it's a negative 46 deltas. The next strike that we're selling, we sell two options that have a 23 delta. We're delta neutral. You'll see by looking at the normal distribution curve that this spread will be trading roughly for about 0. Okay, if we look at this strike right here that I'm looking at, right at the 1 sigma, 1 standard deviation line, and then we go down one strike there right here at about 14%, you'll see that the price of the option we're buying is roughly twice the price of the option we're selling. So the spread will be trading for about 0. Also, delta works in the same way. For those who've never graphed out delta, you'll see that if you graph out delta, delta follows a normal distribution curve just like this. And so if this is a minus 46 delta, the option we're buying, the option we're selling down here has a negative 23 delta. It's roughly half the height of this normal distribution curve. So the next logical question people have is, well, if ratio spreads are delta neutral, why buy the tail and turn it into a butterfly? Well, professional traders usually don't. On the trading floor, we usually didn't ever buy the tail. And the reason for it is something called risk-based margin. Or on the floor, we called it market maker margin. On the trading floor, they allow us huge amounts of leverage on our money. And the reason for it is liquidity. It would not help or behoove anybody if market makers were under the same capital requirements or restrictions that the public was, because our money would be tied up, frozen, and in positions very quickly, and we couldn't make trades. And how frustrating would it be to you guys as retail traders, professional traders even from home, who are calling up wanting to put a trade in, and all of a sudden you get a phone call back from your broker, well, you know, it looks like you could do your trade, and it should have gotten filled, but it didn't get filled, so we go down to the trading floor, and all of a sudden we got all the stories that a big order had come in yesterday, and everybody took the other side of it, and all their money's tied up. And the market maker said, we'd love to do your trade, but you're going to have to wait until expiration until all our positions come off and our capital's freed up. It would be very frustrating for any retail trader to be told, come back next month. What would really essentially happen is the confidence of the markets would be ruined and nobody would participate anymore, and the system would break.